Ladies and gentlemen, welcome back to another video. I'm your host, TheDividendAristocrat, and we've recently hit 1,400 subscribers on the channel, so thanks to all of you for joining me on this journey and tuning in. Now, of course, with all these new subscribers, I have been seeing a lot more questions in my comment section, and one that I've seen pretty frequently is what is the composition of my entire portfolio? Now, of course, taking a look at my portfolio dashboard, there are a couple places where you can see all my total holdings, including this graph right here, the dividend yield versus yield on cost, this graph over here, which is my annual dividend payout per stock, and my weighting by holding, which is broken down into a pie chart. Not only that, but when I do cover the My Pie section of my portfolio, it does have every one of my holdings, as well as the amount that I have in each holding and the allocation. So if you guys ever do want to reference it, make sure you're keeping up to date on those. However, I have yet to make a specific video on the channel covering every single one of my holdings and showing all my dividend income and breakdown for each holding, so I thought today would be a good opportunity to do so just in case. If you guys do enjoy this type of content, I would appreciate a lot if you could subscribe to the channel. I'm on my way to 2K and it would help me out a ton. As a reminder, this is not financial advice and I'm just merely sharing my opinions on this channel. Now, to get started, let's take a look at my portfolio dashboard. We can see that in total I have $30,000 invested over 22 different total holdings, which we can see right there. And my portfolio value is sitting at $44K, which is about $13,750 in the green. Now, to put that into perspective, that is a 45.82% total return, which I am very pleased with, and I have earned $1,284 with the dividend income so far. Going forward, my yearly projected dividend income per year is $738, and my portfolio yield is sitting at 1.69%, which is nice and low the way I like it. The reason I do have a lower portfolio yield is I prefer to focus on dividend growth stocks, one that are able to increase their dividend at a pretty fast rate over time. The reason I tend to focus on those kinds of companies is because I believe that companies that are able to continuously grow their dividend aggressively probably have a better moat and have better economic fundamentals, and they will in turn have a better total return in the long run. Now, I do have some higher dividend yielders like Altria Group, which we'll cover in a little bit, but most of my holdings are pretty low in terms of their dividend yield. My yield on cost sits at 2.46%, and that's because the price appreciation has outpaced dividend increases. Now, I'm not going to go into any more details for my portfolio dashboard because a lot of that will be covered in one of my upcoming videos, which will talk about my dividend income for the month of October. So if you guys want to see that, make sure to stay tuned to the channel. Now, with that being said, I thought we could first jump into the My Pie section of my spreadsheet, which is one of my favorite sections within my portfolio managing spreadsheet. Now, we do have a lot to get through in this video, so hold tight and I'll try to go through it as quickly as possible. So first of all, we can see here my current allocation between my portfolio value and my cash, and so the cash makes up about 15.3% of the total value of investable assets that I do have. Whatever is sitting in cash at the moment is money sitting in the money market fund within my brokerage account. Now, the portfolio itself is broken down into three different sections. As you can see here in red, blue, and green. The red section is my key to success section, which is the largest portion of my portfolio with a target allocation of 50%, but it's currently sitting a little bit lower at 47%. Now, the blue section is where I hold my dividend stocks, and it's called the Divine Dividend section, and its target allocation is 40%, but it's currently sitting higher at 46%, and it's because I've been moving up some companies from speculative over into divine dividends like Google that have now started paying a dividend. And last, in green, we can see the smallest section being 10% of my portfolio, and I call it my speculative section, but really it's just a catch-all section for companies that either don't pay a dividend or have not had such consistent earnings increases over time. My actual allocation for that position right now is about 7%, so of course I will have to do some rebalancing, but my preference is to rebalance by adding money and not necessarily taking away from other sections. Now, down here we can see each pie, which shows the holdings within each section, and if we press the slices button, it will actually open up each pie and show me every single one of the holdings with their allocation. So the first and largest is key to success, and my target allocation here is split between VOO and SCHD, with 70% being for VOO and 30% being SCHD, where my actual is a little bit off at 74.26, so I'll have to add in some more money into my SCHD position. Now, this pie acts as the foundation to my portfolio, and the reason I have such a large holding in both these positions is because I do want to track the S&P 500 by investing into VOO, but of course I also want some increased dividend income with SCHD because I do like the holding and the companies within that ETF. Now, moving over to the second section, we have the Divine Dividend section, making up just under $20,000 with my portfolio right now, and there's a decent amount of holdings in here, including Google, United Health, S&P Global, Microsoft, and Texas Instruments, just to name some of my largest positions within here. Now, in yellow, we have Lowe's and Home Depot, and the reason they're highlighted in yellow is because I've been considering keeping one or the other, and if you've been paying attention to the polls on the channel, I've asked this question quite a few times, and I think the majority have voted to keep Home Depot instead of Lowe's, so I might make that change at some point in the near future. The main goal for this section is to hold high quality dividend growth stocks, and that's why you can see here that all these companies tend to increase their dividends, aside from Google, which only now initiated a dividend, but I do have hope that they'll increase the dividend going forward. Lastly, we do have the speculative section at the smallest allocation of my portfolio, and there's a lot of companies here in red, and those are because they are on the chopping block. Ford, 3M, and Intel corporations are all companies I'm not planning on holding on to, long term. Now, the main reason with Ford is that I don't think this company is a consistent compounding machine, and it only makes up a small percentage of my portfolio. And with 3M, it's because I bought it for the turnaround play, and the same can be said for Intel Corporation. Now, 3M is finally in the green, but with such a small percentage of my portfolio, I'm probably going to be selling it pretty soon. And Intel Corporation, I'll be holding on to a little bit longer, which I'll go into more detail in the next section of the spreadsheet. Other companies here include Amazon and Tesla, which both don't pay a dividend, and PayPal, which also, of course, does not pay a dividend. So moving into the portfolio holdings section of my spreadsheet, I just want to show you guys real quick in a zoomed out view all the different holdings I have here. And of course, these are the same holdings as the ones in my pie section, but I've just organized them from my biggest total return all the way down to my lowest total return, which is Intel Corporation. So zooming in, we can start with Amazon and work our way down. I'm not going to spend too much time on every single one of these positions, and I do have focus videos on each of these different positions. If you guys want to watch them, I'll try to pin some of them up here, and if not, I'll put them in the description of this video. Now for my first two, both Amazon and Microsoft are covered in a separate video, which I'll leave up here, but we can see that the total return is sitting at 89% and 83% respectively, and at some point they were over a 100% total return. Now I bought these companies quite a while ago on a dip at the same time as I was buying Apple, and Apple is also sitting nicely now at a 74% total return, but their price to earnings ratio have increased pretty aggressively and the valuation is kind of sky high. Now in terms of dividend income, none of these companies have anything to write home about. Microsoft and Apple both have very low yields, and Amazon of course has a 0% yield at the moment since it does not pay a dividend. Apple tends to grow their dividend very slowly, closer to 4% dividend increases, and it mostly focuses on stock repurchases, but Microsoft actually tends to grow at double-digit increases above 10% per year. Now in terms of these three companies, I'm not looking to purchase any more shares in any of these at these current valuations, but if the price does drop a decent amount, I'll be looking to make some purchases into any of these depending on what their valuations are going to be. If anything, the one that I think is closest to fair valuation right now is Amazon, and after that maybe Microsoft, but Apple's valuation is very, very high at the moment. Next we have MasterCard, which is sitting at a 64% total return, and it's a pretty small position in the portfolio. I like this company a lot. I also hold Visa, which is its counterpart, and we can just skip down here to see that position while we're already at it, and Visa's already up 37%. Now in reality, Visa's performance is much more similar to MasterCard, but since I purchased another share when it dipped down to about $2.55 per share just a couple weeks ago, it's brought down my total return as well. If I had to pick between the two, I think I'd buy Visa going forward and just continue growing that position instead, because I think it has the foundation and the history to perform well going forward. Now I do think MasterCard has a better chance at growing faster in the near future because it has much more room to expand its services, but I just like Visa as a company a little bit more. Up next we have VOO, which is my S&P 500 ETF, and this has performed amazing for me. I haven't purchased any new shares in quite some time, but we're up 62% in the portfolio. Now in terms of my actual total return based on the initial purchase of this position, I would probably be much closer to 80 or 90%, but of course I purchased a lot of shares over time, kind of dollar cost averaging into it. In total, I own 28.347 shares with an amount invested of $9,400 with a current value at $15,200, which puts me about $5,800 in the green. I am a very big fan of VOO, and I have confidence that the S&P 500 will continue to perform well going into the future, which is why my 401k is allocated 100% in the S&P 500. Now what you see in the spreadsheet is just my taxable investment account, and it does not include any of my 401k or Roth IRA holdings. In terms of dividends, I've earned $548 of the dividends so far, which is a lot, and my annual payout is $191 per year, which is fantastic. Now up next we have General Dynamics, which is a defense conglomerate, and it owns many different subsidiaries including Mission Systems, Electric Boat, Bath Iron Works, Gulfstream Aerospace, and General Dynamics IT Systems. This company is a powerhouse, and I bought it on a dip about a year and a half ago, and it's currently sitting about 50.84% total return, which is really good to see. Now I do own a second defense conglomerate in Northrop Grumman, which I'll show you in a second, but the dividend yield for General Dynamics is slightly higher than Northrop Grumman. Down here we can see that NOC, Northrop Grumman Corporation, is actually underperforming General Dynamics by quite a bit. I bought both these shares at about the same time, but the valuation for NOC was significantly higher, which has led to me having a lower total return. I think it is a fantastic company as well, but I bought it at a bit of a premium, which is why I think we have seen a lower bit of total return than my General Dynamics position. Now going forward, I probably won't be investing any more into General Dynamics or Northrop Grumman, and that's not because I think they're bad companies, because I'd rather just reallocate both these positions into just Lockheed Martin. Only time will tell if I'll actually end up doing so, but for now I'll just keep holding them as they are. Next, I have Lowe's and Home Depot, and you can see it's pretty funny. They actually have about the same performance. I bought them both, I think, around the same time, but I also added more into both positions at some points, and they both have performed very well regardless. Now, a lot of this performance has come pretty recently, and I think it's because of the interest rates being cut. People are hoping that these companies will see a boost in demand for their products. Now, personally, I don't really have a preference between the two companies, but I have thought about consolidating them into one position for either Lowe's or Home Depot. So if you guys have any recommendations, definitely let me know down below. At these current valuations, I don't plan on buying any more, but if there's any more dips in price, I might add more into the positions. Next, we have Tesla, and Tesla is a funny one because it's one of my most volatile companies in my investment account. It was once my highest total return in the portfolio at over 80%, probably close to 90%, and then it since fell down a lot and now rebounded back to about 46%. Now, Tesla is an extremely volatile company, and I do think they're going to have a hard time going forward. People are really betting on them making a ton of profit off of the robo-taxis, but I don't see that happening in the foreseeable future. Right now, they're estimating that in 2027, they'll have it up and running, but I think it's going to take much longer than that. Now, at these levels, I am definitely not adding any more into my Tesla position. I have 3 shares right now, and I just buy them when they have pretty deep discounts. I bought some around 150, and then some I think around 140 when it dipped down once again, and because of that, I've seen some pretty nice share price appreciation. Next, I have S&P Global, which is one of my favorite companies in my portfolio, and below that we can see Google at about the same total return. Now, just a couple months ago, Google's total return was sitting at much higher than this at about 100% total return, but has since dipped down a decent amount. It dipped down in price to about 150 where I picked up another 3 shares, and because of that, it brought my total return down because my cost basis went up. Now, at these levels, I have been very tempted to add more shares of Google into my position, but I haven't done so just yet. I was really hoping it would dip down below 145 per share where I would have added more into my position. If the price does dip down below 150 again, I'll probably add more into my position, but otherwise I might hold off for now. Now, in terms of S&P Global, I have a very large position in this company at 2650, and I have seen a good amount of price appreciation this past year. Now, when I bought it, the valuation was pretty high, but now the valuation is even higher, so I think the company is going to continue performing well, but I'm not going to be adding at these levels, especially since it's already about 6% of my portfolio allocation. Now, up next, we have PayPal, which is at 44% total return, and this one is a little crazy because for a very long time, I was sitting very flat on this position, and now I'm sitting pretty nicely on it at 44% like I mentioned, and the position's worth $1,200 in my portfolio. Now, the company recently had a new CEO take the lead, and so far investors are liking the changes coming from that. Now, I did buy PayPal as a turnaround play. I thought it was too cheap to ignore, and I purchased a couple shares of this company, and if the price goes up high enough, I might decide to sell the position. Otherwise, I'm very happy holding this position short term, and if the price does dip down below $60 per share, I'll probably be adding more into my position in PayPal. I'll skip Visa since we already covered it, but we have Texas Instruments next, which might be my largest position in the portfolio at $2,800. Of course, behind schd and VOO. I don't count those since they are ETFs. Now, I bought the company while it was dipping down. I think my first purchase was at $175 per share, which was a little bit high. I think I got a little bit excited, but then I kept buying it down as it approached $140 per share and was able to lower my cost basis significantly. I think Texas Instruments is a very solid company, but it's going to have a hard time ahead of it. Its valuation is sitting pretty high right now, with expectations being pretty high that it's going to have more demand for its semiconductor manufacturing. Now, if this demand is not as high as expected, Texas Instruments stock price will be hurt pretty significantly, and I might decide to pick up more, but for now I'll just be holding onto this position, especially at these levels. Ideally, Texas Instruments will be a long-term holding of mine, and so far it's paid me $73 with a dividend income, and going forward I'm expected to be paid out $78.50 per year as long as they don't cut their dividend. Next, we have Target, which is a retailer. It's not my favorite position in my portfolio, but I bought it on a pretty significant dip. Originally, I actually bought it at $145, which is not that cheap of a price, but as it dipped down towards $100 per share, I added more into this position, giving me a total return of 31% now that it's rebounded. It pays me a solid dividend with $34 earned so far, and going forward I am expected to be getting paid $28 per year. Now, next on the list we have schd, which is at 38.18%, which is significantly lower than VOO, my other ETF that I do hold, but that's because it has had a lower bit of price appreciation compared to VOO, and I've been adding more into this position than I have VOO, bringing my cost basis up. After the split, I do have 186 shares, including dividends being reinvested back into the company. My total position is at $5,300 with a total dividend income earned of $308. Going forward, I am expected to be paid out $182 per year, which will give me a decent amount of shares being reinvested back into the company. Now, speaking of dividend reinvestments, I do want to just clarify that I do reinvest all my dividends back into the same companies that pay it out. Now, real quick before we continue, if you guys are enjoying the video so far and have made it this far, please leave a like on the video. It does help out out the channel a lot. So next we have Altria Group, and this is my highest dividend payer in my portfolio. It's actually seen a good bit of price appreciation this year, putting me at 28.38% total return, and I have a pretty substantial position at right under 3%, which is where I like to see it. Now I'm not planning on increasing this position much because I want it to stay between 2 to 3% of my portfolio, but my yield on cost is sitting at 9.43%, which is crazy, and the current dividend yield is at 8.22%. Because of that high dividend yield, my annual payout is one of the highest in my portfolio at $100.55, and my dividend earned so far is at $120, which has been reinvested back into the company to get me almost 3 shares of MO for free. Now before you guys come at me in the comments, of course dividend income is not free. It's part of your total return within the company, and you have to of course pay taxes on it. I do understand. Now we'll skip Northrop since we already covered it, and then we have 3M at 19.34%. This one has been a bit of a wild ride. I bought it at about $125 per share. Actually, you can see right here, $124.68 per share, and the current value is sitting at $148.79. Now while holding it, the company did dip to under $80 per share, and I really wish I would have picked up more shares of 3M, but I didn't have the capital aside at that time, and I was not paying quite enough attention if I'm being honest. Regardless, I have continued holding this company because I am confident in their turnaround. If the stock price gets high enough, I might decide to sell this position because it makes a very small allocation. Now for our last three, we have United Health, Ford, and Intel Corporation. And for United Health, I actually like this company a lot. I have 19% total return on it so far, and I had a pretty big dip after earnings were released this week. Now, a big reason I do hold United Health is because I think they'll continue having a great total return and great dividend increases. Most of their dividend increases are above 14% for the past couple of years, which is amazing. But another reason is also because I use it as a hedge to my insurance plan. My insurance plan is unfortunately through United Health, and they are a bit of a pain in the butt to work with. So the way I see it is if United Health stock price is doing well, then my insurance plan is probably doing poorly. But if my insurance plan is doing well, then United Health is probably doing poorly. So it's kind of a hedge against my own health insurance plan, if that makes any sense to you guys. Their dividend yield is relatively low, but because it's a large position, I've earned $28 so far, and each year going forward, I'm expecting getting paid $42.46. Now with Ford, I was sitting pretty nicely on total return a while ago at 44%, and I considered selling before earnings, which I should have at $14 per share, but unfortunately I did not, and it dipped about 30% after earnings, bringing my total return way down. Even right now, we can see that the current price sits under the price I paid for each share. So even though I'm in the green because of dividend reinvestment, I'm actually doing quite poorly on this position. Now it only makes about 0.2% of my portfolio, so I'm definitely looking to sell it soon, but I just haven't pulled the trigger yet. Lastly, we do have Intel Corporation, which is the only company of mine that's in the red, and the reason I bought this company was for a turnaround play. I initially purchased a couple of shares around $28 per share, and the stock price went up pretty high, over $40 per share, which I should have sold it then. During that time, it was the best performing company within my portfolio with a total return above 80%, and I believe it was about a year ago from today when that had happened. Since then, the price did dip a bunch, and I bought more shares at around $30 per share, and then since then it dipped a lot more after really bad earnings, and I bought some more just to bring my cost basis down. If you guys want to see an old video I made about Intel Corporation and why I purchased it at the time, you can check out this video right here. I still think a lot of the points still stand from that video, but of course some of the points have changed since then. Now to put it bluntly, Intel has not been performing well, not financially and not in terms of stock price either, and the company is not doing well at all. Now I still hold it because the reason I bought the company is the same reason I hold it today, and that's because I do believe they'll be able to turn it around. I just think it's going to take longer than I first imagined. Now my goal for this position is to keep it at about 1% of my portfolio as a risky play, and right now it's sitting at about 1.3% of my total allocation, so I'm definitely not going to be adding more into this position anytime soon. I think the next couple quarters will be hard for the company, and this position may go far more negative in the near term, but in the long term I hope that they'll be able to turn it around. If not, the position is small enough to where it won't affect my total portfolio value too much if I do end up losing the money invested into it. As always, that does bring us to the end of today's video. I really hope you guys enjoyed seeing this deep dive into every single one of my portfolio holdings. There have been a decent amount of requests for this recently. I just wanted to make sure I got this video out in case you wanted to reference it now or in the future. If you guys do have any questions about my portfolio or any of the holdings within my portfolio, definitely leave them down below, and also let me know if you have any of the same stocks that I own in my portfolio in yours. Also, I do occasionally make review my portfolio videos for the portfolios sent to me by my subscribers, so if you guys want to be a part of it, leave your total portfolio holdings down below and I'll get to it as soon as possible. If you haven't yet seen my last video where I go over the schd split and how to fix your spreadsheet in order to account for it, check it out right here. And if you want to see the video before that where I talk about my dividend income for the month of September, check out this video right here. Remember, the best time to invest was 10 years ago. The second best time is today. I want to thank every single one of you guys for watching, and I will see you in the next one.